Today's episode of Wine and Dime is sponsored by Rooted Planning Group, a fee-only financial planning firm that believes life is about events, supported by your dollars and cents. And we want to help you achieve your goals. Hop on over to www.rootedpg.com to learn more about the services. Every week, it's my goal to share financial information that helps you in both your life and Financial Vineyard. We hope it takes you from your roots to the journey of your vines and the influences in the air that have helped craft your delicious life. Like wine, life and finances have different palates that should be celebrated and not judged. Welcome, Wine and Dime listeners, to this episode with a special guest, Kate Welker. Kate, welcome back to the show.
Hey, Amy. It's nice to be back on the show again.
It has been a while. We've been in the thick of the wondrous tax season at Rooted Planning Group, and I know you've had your head down and been focused on client meetings and tax discussions the first part of this year, but as we're recording it, this is actually March 30th as we're recording. It won't be released until mid-April, but we're almost there. We're almost the push.
It's always the light at the end of the tunnel season of, questions and projections and planning. It gets a little more intense for the next couple of weeks. And then there's a little sigh of relief.
I like how you use the word intense.
Intense.
It's so funny when I was putting together the list of wines, as many listeners may recall, I have been traveling with my taste buds, and I was featuring wines from Oregon over the past couple of weeks. Mm-hmm. And the winery in particular that I've been featuring is Pudding River. That was one of the wineries that we went to when we were out in Oregon last year. And I thought, let's go out with a bang with a port-style Shiraz dessert wine. Now, port is a sipper, right? Port is one of those wines that's a super sipper. It doesn't require a lot. It's got a ton of flavor. It's super sweet. It's definitely what I would consider a dessert wine. Mm-hmm. This particular wine, I should get you some and to have to celebrate after April 18th. It's actually from the Walla Walla region or Walla Walla Valley region. And when we were out there, we had just a tiny little bit of it. And I was like, ooh, that's a nice little kick. It's a nice, and it's a good winter wine. I would say it's a good sipper, but
it's so winter here. It is spring, but it is still winter here. I am looking out upon frost and a little bit of snow on the ground this morning.
Sorry.
It's okay.
So speaking of head down, final push, we're in that final stage as this podcast will come out. We'll literally be in the last week of tax season. One of the things that I thought, as you recall, I've been doing a series on breaking down the 1040. Mm-hmm. And I wanted to save this part for the last because it seems like, so this is part 5. If you haven't listened to the other 4 parts, which was basically breaking down the front side of the 1040, what we call the back side and front side, the difference between the two. We did in part 2, schedule 1, which is your adjustments, pluses and minuses to income. Then we did schedule 2, which is your additional taxes. We followed that by schedule 3, which is additional credits and payments. And so today I thought we would focus on the small business aspect of tax season. And Kate, you and I work with a lot of small businesses. That's one of our, what I've learned is a term to be zone of genius. This is a new term for me, zone of genius.
Okay.
ZOG, they're calling it. This is fun terminology for me. The financial planners, we love acronyms.
We love acronyms. Yes, I like that one.
So you can't just say zone of genius. You have to say it's our ZOG. So,
all right.
I didn't realize that this was a ZOG for us, but I've recently learned that if you take a step back and look at the clients that you work with and the commonality of it, we have a lot of clients that have a small business similar to you and I. We're running our own small business, right? So mm-hmm. I think that attracts that kind of particular client, especially women. And so I thought it would be good for us to sort of dig into that, starting with some basic terminology. We get a lot of questions about what tax forms need to be filed if they're a small business. So I'm going to kind of let people hear me talk all the time. I thought I'd let you sort of explain to clients what the difference is between filing a Schedule C, filing for an S Corp. What are some of those differences just on a basic level?
Yeah, absolutely. This is, as you said, a really big question we hear. And I think people don't always understand the tax implications that follow your business decisions. So it's always good to start out knowing exactly what you're expected to be doing when it comes to tax time if you are opening a business. So the most simple form of business ownership is a sole proprietorship. This is when you start a business. You have not done any additional legal steps to make yourself an LLC. You have not filed as a corporation. You're just opening a business. You probably have a DBA. You might have filed with the county. And the next step up from that would be someone that does have an LLC, but they're still just a single owner, sole proprietor, no elections. If that is your case, you're going to file something called a Schedule C with your personal tax return. It's an additional schedule. It's sort of like a mini business tax return that flows through to your personal tax return. A lot of times people start a business and will say like, hey, I was talking to my accountant and they didn't file for my business yet. I'm like, well, it's on your return. They just don't realize it's all together in one situation. And that profit at the end carries over, it flows to your personal return, just like if you had a job or something. Another big impact is that bottom line number does have an extra tax. It's that self-employment tax piece that gets tacked on the end of your tax return. But that is how you would file. If you were still kind of a small business, but you had a business partner, you'd have to file a partnership return. And that is called a Form 1065. And that one is actually a separate tax return. You file a separate tax return and it will generate a K-1 for each of you with the profit. And that's going to get reported. Again, these are all pass-through. Pass-through means it passes from the business to you as a person, an individual on your tax return. So you'd add that to your income. And again, partnerships are still subject to that self-employment tax. The next level, someone could file as an S corporation. I think Amy could do a whole 2-hour podcast on an S corporation. So I will try to make it very brief. So if you are set up as an LLC, you can actually elect to be taxed as an S corporation. You don't have to actually form an S corporation. It's an interesting little, I don't know if it's a loophole, a technique you could take advantage of. So some small business owners that have an LLC will elect to be taxed as an S corporation, and then they file again a separate tax return. This one's called an 1120S. And the same thing, you'll file this return for your business, and then it'll generate a K-1 that's going to pass back through to your personal return. The potential tax benefit is that those earnings are not subject to self-employment tax, but you have to give yourself a W-2. Like you have to have payroll set up, be issuing wages. So there's still some payroll taxes being paid.
And just one little side note, because people hear that final statement you just made and they're like, oh, well, I won't pay myself very much. It has to be reasonable compensation. And that's something that we really work with our clients on to find out, well, what would be a reasonable compensation for somebody who is doing your job? What would you need to pay yourself? I mean, the basic, there's two pieces to being a business owner, right? One is the fact that you took the risk and you're an entrepreneur and you've reinvested into the business and you're getting a dividend. And really that's what the K-1 part is, right? It's the payback for you reinvesting into the business. It's a distribution from the business to you for starting the business. And then there is the I'm in the business doing the work part, which is the W-2 piece. Mm-hmm. And, that the benefit of not switching, because people that are an LLC can still file a Schedule C, as you mentioned, and that's considered a disregarded entity. In some states, you have to file like an additional tax document for that disregarded entity. But the benefit of being taxed like an S corp is you also do have you have all the other things that can go along with being a W-2 employee. You have, when it comes to like lending and stuff like that, like that's one of the benefits that I see of having a W-2 compensation is that it does, when you're a Schedule C only business, you are looked at very differently than if you are a W-2 employee. And so having that, electing to be taxed as an S corp has the benefit of some of those kinds of things. And if you're deferring, if you have like a simple IRA or a 401k and you have employees, you also can participate in those plans just like the employees can. So there are pros and cons to both sides. If you're just a sole proprietor, it typically doesn't make that much sense. Sometimes it still makes sense to be an S corp or make the S corp election. But again, you have to do the math on that and make sure that it makes sense, because those are, we always say we want to follow the rules that the IRS gives us, And we truly feel that it's important to make sure that we're being reasonable in any of the recommendations that we're making. So I just want to caveat that, because a lot of people hear that final part and think, oh, well, I'll just take a distribution and I'll never have to pay Social Security or Medicare tax. Not going to fly. Just FYI.
It will not fly. And it is also a hot topic, so to speak, with the IRS right now. It's a really easy thing to track, because there's a paper, you have to file payroll forms. They can match it up to see, oh, you have an S Corp. Are you filing quarterly payroll returns?
Right.
And if not, questions will start to follow that.
Yep. And we like to make sure, what I always say is we want to pay our fair share. I just only want to pay my fair share.
Yes.
So thinking about whether it's a Schedule C or the 1120S, the information is basically the same. So if we're thinking about income, what is income? And I know that sounds like a crazy question, but really, what is income? If you think about what the form looks like, going right down through the form, gross sales receipts, right? Obviously, that's income.
Yeah. So beyond that, income, as you just said it, the form says gross receipts or sales. It's any payment you receive for goods or services that you might provide. So goods could be selling an item if you had a retail type business. Services is if you are in line as either a professional or as any service provider. Anything that you're doing for somebody that they're going to pay you for is income. You could also have some one-off categories. Maybe you earn some interest as a business. That's part of your income too, because it is income that came into the business. If you were going to get real technical, bartering actually is income too. If you're exchanging your services for another service, there's a whole separate tax form for that, but it is income as well. But I just kind of like to leave it broad as if you got paid to do something in your line of work, it's income. Or if it's even tangential to what you're doing and it's not covered by any other tax forms, it's income for your business.
Right. And then thinking about, some companies, if they're that retail supplies company or something like that, they might have returns or allowances for bad product spoilage or something like that, right? So from the income, they could take some of that away from it.
Subtraction.
Yeah. And then cost of goods sold. This is one that is actually very confusing to a lot of people. So this is still under the income line. And a lot of people think of cost of goods sold, well, that's an expense. And it is. But in determining the gross income, we actually have to take off cost of goods sold from the income line. Talk a little bit about cost of goods sold, because I think people think, oh, well, I'm a service business. I don't have any cost of goods sold, but that's not entirely true.
Sometimes there could be. So when cost of goods sold, we're typically looking at any purchases you're making that kind of are required for your business. And I'm going to use a retail example for most of this because I think it's the easiest to grasp. But to look at cost of goods sold, we're looking at what did it cost you to generate that income. So on an item, if you're selling a sweatshirt, we want to look at what did you pay for that raw product versus what you sold for it. And it can be kind of hard to track that sometimes. So to get to that number, we start with inventory. How much did you have in products to start the year? So you had, $4,000 worth of product on your shelf when the year started. What did you buy in those products? I'll say raw products throughout the year. Maybe you bought $6,000 worth. So we're up to 10. And then we're selling things all year long. So we do the inventory again at the end of the year. If you're back down to 4,000 again, well, then we know 6,000 was what you spent, quote, it's gone throughout the year to generate income for yourself. So you want to look at starting inventory, add in anything you bought for the year, and then what's left over to get to what was that cost for items. Now, it never works out even. Typically, if we start the year with 4, maybe we bought 10 and we had a slow year. So now we have 12 left over or reverse. It's just kind of getting down to what that cost is. It also could be cost of labor. So if you are a labor heavy business, like a construction company, maybe you're going to have materials and supplies. You've got to buy the lumber, the siding, but you also may have subcontractors that really were a direct expense. Like you had to hire someone to do the plumbing. You got paid for it, but that was a direct cost of doing that business that we want to make sure we subtract from that number. I think there is a lot of confusion. It maybe doesn't always go in the right spot, but you're still going to get to the same net number in the end, but it just helps track that ratio.
Yeah. And then there's, on the form itself, there's other income that maybe was from federal and state gasoline or fuel tax credits or refunds or something like that. And that could be a whole session in and of itself. So we're not even going to go there today. But if we take the receipts of income, like you said, we subtract off any returns or allowances, we subtract off the cost of goods sold. That's what's going to give us basically the gross profit, ultimately, and in most cases, the gross income. So then we get into the expenses side of things. And expenses, in my mind, are broken into two categories. There's sort of the return or the direct expenses for the business. And then if you are somebody who works from home, you have a home office, and we are not actually going to get into that form today, only because, again, that could be a session in and of itself, and maybe one that we could dive into in the future, Kate. Mm-hmm. Because if you are a home-based business or you work from home, certainly during COVID, we saw more and more people actually give up their office and become home-based businesses. There's a whole separate form that we would have you provide us information on that would be considered indirect expenses. And some of those may be eligible for reduction of your net profit or loss. But there's pros and cons to that too. So again, just want to throw that out there that's a whole separate aspect that we're really not going to talk about today, but is something that should be investigated if you would qualify for that. So thinking about expenses and talking very high level here again, just trying to get people's brains thinking, because sometimes I feel like people do leave things on the table that they don't realize could be something that could be a deduction. Advertising is one of those. So let's talk just a few moments about advertising. It's the typical advertising stuff. You placed an ad in a newspaper. You attended an event where you were the sponsor or something like that. You bought supplies to market your business. Right. But there's also little things like one thing that I always look at are what are some of the organizations that I have near and dear to my heart that I want the business to sponsor and is good for the business too. That could be marketing, right? That could be advertising.
Yeah. And your word right there, sponsor, is a key word. So a lot of times I'll have someone that, we're doing some tax consulting and they have a business and I'm like, well, I really would like to donate to this organization. You actually cannot deduct donations as a business. It becomes a personal draw. You could add it to your personal itemized deductions. A lot of people, though, can't itemize and take advantage of that. Mm-hmm. So, but if you are able to arrange it as a sponsorship of a program, that counts as advertising for your business. Something else that I hear a lot, I wanted to add on, are people that say, well, I gave product somewhere. I donated product. How do I deduct that? And there's actually, again, not a separate deduction, but back up to that cost of goods sold discussion. If you bought a product and at the end of the year, it's subtracted from your inventory, it is actually getting deducted from that overall number. So if you're donating a product to an organization, again, sponsoring an event, I would think of like gift baskets that you get an ad for whatever event's happening. It gets a deduction that way, but it's actually not a separate line item deduction in that regard.
Good point. And then another one that we'll spend just a few extra moments on, the car and trunk expenses. I always feel like that's the bane of my existence during tax season.
It's probably, I think, the most misunderstood. Just thinking of my years in right in heavy tax preparation and working with business owners, and now working a lot of tax planning. And some CPAs just don't do a lot of planning or have time for the questions. So we get a lot of these throughout the year. Understanding how you can deduct expenses for your vehicles. So there's two different ways you can do it. The first way is the most simple way, and this is the mileage deduction. So if you are going to do mileage, you have to keep a log. Sometimes people forget about this piece. You have to keep a log of mileage driven for business purposes. And this could be really anything for your business, going to the post office, going to pick up supplies, dropping off orders, driving to conventions. As long as it's mileage driven and the purpose of your business, you can deduct that. And there's a stated federal rate. It's actually a pretty nice deduction overall, the number you get for that mileage for the year. And it takes into account all the other things we're going to talk about. You could do, it's supposing a little depreciation on your vehicle. It's accounting for gas and parking and wear and tear and maintenance is supposed to be all covered in that expense per year. Some years it's like 2022, they changed the rate partway through the year. So we had to track miles driven January to June and July to December because gasoline prices were changing. They increased that a little bit. So yeah, mileage is the easiest. And real brief mention, buying and selling, when we get into depreciation, you are supposed to kind of add a factor back in if you have a business vehicle. The other way you can do it is actually writing off direct vehicle expenses. So you can put a vehicle in service for your business. You just want to make sure you have really good documentation showing I bought this vehicle and I'm using it 100% for my business. In that case, you probably want to see a logo and you have another vehicle you're driving. There's a lot of documentation to prove that you are using this as a business vehicle. Some are easier. Some are service trucks that you have to have. But if it's a personal vehicle, you also could keep mileage on that and each year say, hey, I drove 15,000 miles, 5,000 was business. So a third of my expenses get to be deducted. And the cost of that vehicle over time. You then also could deduct the actual expense of gasoline, repairs, oil changes, insurance, interest on that vehicle, all those items that go into it. The one piece I like people to know about is when you sell that vehicle, though, you do have to reclaim any depreciation you claimed over time. So you may have a larger gain at the end of the sale of the vehicle than you were planning on if you do it that way.
And you mentioned at the beginning of that they do have to keep a log. I personally use Mileage IQ. It's an app that I have on my phone that basically tracks the miles for me. So when I hop in the car and it allows me to go through, I take my phone with me. Most people take their phone with me wherever they go. It's just constantly running in the background. And so when I hop in the car, if I go to the grocery store, I just categorize it as, personal. But if I go to the grocery store and I'm picking up office supplies, then I categorize it as a business expense, right? So it's automatic. It just automatically captures every time. In fact, it's funny because if I go out for a jog, it'll pick that up.
That's funny. That's quite humorous. Yeah, I love the apps for that reason. You don't have to think about it.
That's
it's just there.
But then I print it off at the end of the year, every month or however you want to do it. And there's my log, right? I don't have to write it down. It's not pen and paper. It's like $50 a year for this app. I don't care. To me, that's I'll spend the $50 to not have to, remember to write that down every single time. And you can put notes in that. Now there's probably other ones out there and I'm not endorsing Mileage IQ. I'm just giving an example of something that I use as something that makes I think my life easier.
QuickBooks Self-Employed has a similar feature built in. I'm not positive, but I believe I've been told that version has something similar that pops up when you drive.
I just think it makes life so much easier. So
yeah. To track it all.
Okay. So then moving down through the list of items, some of this stuff like commissions and fees, contract labor, depreciation is a big one, right? That's another one that I think, sometimes people don't understand the difference between depreciating something over time versus taking a 179, immediate year depreciation, and where else it might go in the schedule. Sometimes office, so somebody will say, I bought a desk, so I put it under office expense. Well, technically a desk should be a depreciable item because it's furniture.
Yeah, where that limit is. So, and I used the word depreciation earlier and didn't define it. So that's a great reminder. So depreciation of an asset is when you purchase it, but we add it to a special schedule, depreciation schedule, and you only take a part of that each year. So the simplest depreciation is straight line, where it's going to divide it by whatever its life is. So the IRS has charts that determine how long they think something should be in use. Office equipment, generally 5 to 7 years. Buildings are 27 to 39, all these timetables. And then depending on your method, it will take a little bit. So modern depreciation is called accelerated. So you'll take maybe 30% of it in 1 year and then 20, and it decreases over time. With that, there's also bonus depreciation in Section 179 that you still have to add that item to your schedule, but you could take all of that expense in 1 year. Again, something we could spend another podcast on, just depreciation. Many sessions on that with that asset. But determining where it falls is looking at the size of it. So years ago, a couple of years ago, we'll say, when I started doing taxes, it really was around $100. We looked at something, and if it was over that, we wanted to put it on the depreciation schedule. That they call it a safe harbor limit has increased. So what you can call a supply has gone up. I actually, off the top of my head, don't know this year's. I think it's around 500. But there's another election you can file that's more like 2,500 that just says basically if we're buying small items, we can call them supplies. We realize the phrase is de minimis. They're not large enough to be a huge impact like that on the return. So again, this is something you'd want to work with your CPA or tax preparer with on the prices. I typically tell someone, if it's something over $500, list it separately. And then we can look at that year's specific rules and determine how to treat it. Again, if it's I can remember early on depreciating fans, like all these little things in office chairs. And now we're getting into like tractors and vehicles and, large storage systems, again, larger expenses over time.
Mm-hmm. Yeah. And there's so many other items. I mean, my gosh, we've been almost 25 minutes into this podcast, and I feel like we could do part 2, 3, and 4 just on the expense items. But another key area that I want to make sure that because there's things like employee benefit programs. And when you're a solo, especially, you have to be careful about what falls underneath that, right? Because some of that isn't deductible, some of it is, right? So we have to be careful when you're a solo on what is actually deductible and what isn't. There's insurances for like your liability insurances, again, maybe your E&O insurance would fall under there. There's
your health insurance wouldn't.
Yeah,
right.
Yeah. There's interest and mortgage. So one thing that I just wanted to mention, because people automatically assume that the full mortgage payment is deductible, and
it's not. No, it's just the interest on your mortgage that's deductible. Yeah. So if it was business property, if you, owned a commercial building for your business, that building itself would be on your depreciation schedule and getting deducted on its own. So the mortgage would kind of be double dipping if you took the payment principal plus interest. So you just deduct the interest. And then that's not on your home office. As we said earlier, that's a whole different schedule that gets filed. This is on business assets.
So something to be aware of. The interest, like you said, Kate, is deductible, but the principal needs to be separated out. So when we're asking you for that information, that's another one of those things that we go back and say, well, is this just the principal side, or is this just the interest side, or is this both? There's legal and professional services. That's a big category for service-based businesses. I know that's one of our big line items, because a lot of, if it's not the team that we're paying, a lot of it is those professional services, software, subscription services that we're paying for to give the service to the client. Office expenses, pension and profit sharing plans. That's a big one. And that's one that, again, we could probably spend a whole session diving into. I do want to give it its due diligence on the side of, making sure mentioning that is an opportunity for especially solopreneurs, that a lot of people don't realize there's something called a solo 401k, that they can deduct a much larger contribution than a SEP contribution. And that can be a huge benefit to them especially if they have an unexpected profitable, largely profitable year that they didn't plan for. What a great thing to have happen.
Yes.
And now we can open those plans after December 31st. Well, we can fund those plans after December 31st. So that, there's some benefits to those that we don't want to bypass. Real quick, another area that I see as a quote unquote like problem area is travel and meals, because there's two different kinds of categories for travels and meals. One is meals while you're traveling, and then one is like the deductible side of meals, right? So maybe spend just a few moments talking about that.
Yeah, this is an area that was, it's a high abuse area, as I'm sure you can imagine. So it is a little more scrutinized. And over the last 5 years or so, there's been a little more regulation on what is deductible, including the biggest change is that entertainment is no longer a deductible expense. So you used to be able to take clients to a ball game, and you can now lower deduct the cost of the ball game itself. So what you're getting into with travel and meals, on the travel side, these are expenses traveling for a business purpose, and it needs to be a legitimate business purpose. So if you're going to a conference and your travel there is the conference, you can deduct, everything, your airfare, your Uber, the meals that you need to eat because you're away from home, hotels, conference fees, all of that travel. There is a way to still deduct travel if it's part business, part personal. Consult with your CPA or accountant before you do. If you are doing that for the actual breakdown, so there are certain ratios that are used about time traveling, time spent in business, and how you would deduct that. I think the takeaway is no, there is a way, but ask a lot of questions and document it. And then on the meal side, looking at deducting meals are they for a business purpose? Are they for the convenience of your employer? So if you're just at work and you run out to get lunch, it's not going to count as a meal. You could pack your lunch. You could bring it with you. You don't need to do that to run your business. But if you're taking clients out for a meal to discuss a situation or is a thank you, that's deductible. If you're taking team members out, that's deductible. If you have a team and you're working on a project and you pay for a meal for that team for your convenience, so they don't have to take time away, you can deduct that. So again, it's looking into the overall purpose of that deduction.
And keeping those books clean on that is really important. So, if your number ever gets picked and you do have some kind of audit, they're going to ask for the specifics on that. So make sure that you keep some details on some stuff like that.
Yes.
Because we've gone a little bit longer than we normally have, which I knew was going to happen with this particular topic, because it's just so, we probably could have broken this down into 6 episodes in and of itself. We've talked a lot about expenses and the total expenses from running the business. But if you are a solopreneur, like you were talking about, like it's just you basically, maybe you have some employees, but you're running it as a solopreneur LLC, not being elected as a tax corp. One other thing that I always want to point out is the Schedule SE that goes along with the Schedule C. That is the self-employment side. You mentioned this earlier on, Kate. You actually, kind of said something about the Social Security and Medicare side. If you are a Schedule C filer and you have a profit, you need to pay for both the employer and the employee side of Medicare and Medicare and Social Security.
Mm-hmm. Yes, you got to make sure you're covering both, like you said, because you are your own employee and your own employer.
So that is something that a lot of times when businesses are first starting out, they're like, oh, my tax bracket's going to be so low because my income for those first couple of years is going to be low. So I'm not going to make estimated tax payments. I say, whoa, Nelly, because yes, your tax bracket might be very low. Like your standard deduction may cover your profitability, but that does not include self-employment. You still have to pay that. You could owe 0 in federal and state income taxes, but you're still potentially going to owe self-employment taxes. So
yes,
don't fight us when we suggest to you that you make estimated tax payments.
It is for your own benefit and sticker shock at the end of the year. Yeah. Something else I wanted to add quickly, just kind of getting onto the overall expenses is, starting out, sometimes people ask me about what to deduct, and I will tell them to pull a Schedule C. Even if you have an S corp or a partnership, the types of expenses are all the same because it lists out those categories. And I think sometimes it can help to sort of define the types of categories you should be tracking. And there's a lot of interpretation in tax code where things are. There's black and there's white, and then there's kind of, what does this even mean as a deduction? So that's where I say to just take a step further and talk to an accountant or pull up the instructions if you are so inclined to really read into like, what is the definition of that expense if you can. And if it feels like it's something for your business, it's probably deductible. So keep track of it as well. And you can always ask someone.
Well, Kate, this has been fun. I always love jamming with you on these kinds of topics. It's always fun to play the back and forth, process especially because people probably, when it's just me talking about this, I can just envision that they're going to be like, oh my gosh, this is going on and on and on. But it's been a joy jamming with you once again on taxes. And certainly we hope that all of you listening today's shows have enjoyed this particular topic. If you are a small business owner and you want to know more about particular topics, please drop us a line and let us know. Certainly feel free to schedule a discovery call with Kate and I if you feel like, we're a good fit for your firm and for your organization to help you. Remember, we don't do just taxes. We do the financial planning around your lives, which includes taxes and investment management and disability planning and long-term care planning and life insurance and blah, 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 blah. And if you'd like to share this with your friends, we sure would appreciate that. Please go out to iTunes and rate us if you get a moment so that more people like you can find us. Thanks, everyone, for listening. And thank you once again, Kate, for being on the show. We've really enjoyed it.
Thanks for having me back, Amy.
And that will about do it for today's episode of Wine and Dime. You can contact Amy through the website, www.rootedpg.com, or amy@rootedpg.com. You can also follow us on Facebook and Instagram @rootedpg for the latest news. And if you have any questions, comments, or topics you would like to hear about, feel free to let us know. And don't forget to rate and subscribe the show wherever you get your podcasts. And again, thank you for listening, and be sure to tune in next time.